folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know how things are doing out there. S&P 500 right at 6379 while I'm speaking. That's up about 8.7% for the year. However, it's down about 1.4% over the last 5 trading days. So back to Thursday of last week, it's sold off a little bit. And all eyes continue to be on this sort of inflation, unemployment, what's going on soup. All eyes really on the Fed as we try and figure out, what is the Fed going to do to this sort of developing macroeconomic situation. And so I thought I'd spend a little bit of time just talking about what's going on kind of in macro land. First thing to understand is just kind of how tariff revenue has kind of grown over time. A lot of people look at it and say, hey, we've been talking about tariffs for what feels like ages now. It feels like we've been talking about tariffs for 6 months, and we haven't really seen that much of an economic impact. So, it must not be really that big a deal. And for those people, I would encourage you to actually look at the graph of tariff revenues collected over time. Because what's really unique about the way that these tariffs have been phased in is it's really only been over the past 3 months that we've really started to dramatically ramp up the amount of tariffs that are being collected. July was about $28 billion in tariff revenue, higher than June and higher than May before it. And it really, is a dramatic ramp up over time. One of the beauties of our economy is it's a closed loop system on a global basis. So that money has to be coming from somewhere, right? Like if the government's collecting it, it's got to be coming out of somebody's pocket. And there are really only 3 candidates for who that can be. The first candidate, one that, some people would really like to believe, is it's coming out of all of the foreign companies and governments. They're the ones paying all this revenue to the United States. And this is the argument that I like to call the U.S. companies are terrible at negotiations argument. Because what it basically says is, Nike is terrible at negotiating shoe prices. Target is terrible at negotiating the prices it pays for toys from foreign countries. Walmart is terrible at negotiating the price for clothing that it brings into the United States, et cetera. And so, these companies were just getting their faces ripped off by these, greedy foreign corporations. And what really had to happen was the administration had to step in and basically lower prices effectively for them. It a little bit, to me, seems on face kind of rejectable. We generally tend to think that U.S. companies are actually quite good negotiators. They employ a lot of people in their sourcing departments trying to get the best price on everything that they source. And so to believe that, all of this revenue is just going to come from foreign countries sort of presupposes that U.S. companies were doing a terrible job at negotiating prices in the first place, which seems a little far-fetched. The second place that this revenue could be coming from is out of U.S. companies. So just coming straight out of their profit margins. There is maybe a little bit of evidence for this. If we were to see that happening, then we would see U.S. companies start to tighten their belts a little bit. And importantly, we would see them stop hiring or get less aggressive with growth plans. And certainly we've seen a little bit of that. The unemployment rate, while it's fine at 4.2%, that's been fine, but continuing claims have spiked up quite a bit. Initial jobless claims, actually reported this morning, have spiked up quite a bit, indicating that maybe U.S. companies are tightening their belts a little bit. And importantly, the producer price index, the PPI, which is a measurement of, the cost of goods and services that companies are bringing in, spiked 1% in the most recent reading, month on month, to the highest level ever for the producer price index. So it certainly feels like prices are going into those companies. And meanwhile, we haven't heard much in the way of, corporate profits being tightened or squeezed. But I would just remind people that, we haven't really seen third quarter results yet. The single largest month from a tariff standpoint was actually July. That's in the third quarter. So something that we would worry about the next reporting cycle. Last but not least, the third pocket that this could be coming out of is just out of the pockets of U.S. consumers as prices go up. And we haven't seen a ton of evidence for that. Last month we saw core CPI prices raise about 0.3%, so not skyrocketing by any imagination. However, I would just note that 0.3% is a little bit higher than the 0.1 to 0.2% that we had been running at for the prior 5 months. And so it is some evidence that, prices are starting, things are starting to heat up in the kitchen a little bit. The answer is probably that it's going to come out of every one of those pockets that I just mentioned to some degree, right? It's probably not going to happen that there's just going to be one responsible party. But that in and of itself presents the problem to the Fed, because if companies are experiencing some of the pain domestically here, then that spells some bad things for unemployment. But if companies are passing those prices on to consumers, then that also spells some bad things for inflation. There is some confusion in the marketplace about what is the Fed going to do in this environment where we see, potentially prices going up for consumers, inflation, but we also see unemployment potentially being a problem. Which of those is the Fed going to try and, react to? I think earlier, sort of late last week, the idea was that the Fed was going to be more concerned about unemployment, given some weak unemployment numbers that we saw. And the market kind of rallied around that because, if they're concerned about unemployment, they're going to cut rates. More recently, we've seen some data come out that suggests that the Fed is actually more concerned about inflation than it is about unemployment. Unemployment's still at that 4.2% level. We talked about that earlier. Still at that 4.2% level, which is, acceptable. And meanwhile, they're seeing both the CPI, the core at 0.3, which is above where they'd like it. They're seeing the PPI spike dramatically. The Fed actually came out yesterday and said that the majority of the Fed is actually more concerned about upside risks to inflation than they are about downside risks to unemployment. A little bit of a market sell-off, as we talked about over the past couple of days, with this idea that maybe the Fed's not going to cut rates, in an effort to try and keep inflation contained. So we shall just have to see. Jerome Powell speaks tomorrow, actually, at a conference out in Jackson Hole. I think all eyes will be on them as we continue to sort of see this developing macroeconomic situation play out. But I would just, caution everybody, as they look at, as you look at markets, as you look at the economy, that the impact of tariffs hasn't really been felt yet. It's just starting to roll through the economy, as evidenced by, the amount of tariffs that we collected in July. And so we'll really have to get some data from July, August, September before we know exactly how this is going to play out for the United States. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.